Apple is trading at all-time highs, and in this video I am going to analyze Apple stock by looking at some important metrics like their debt and their dividend. And finally, I will be using my Excel spreadsheet to come up with a valuation for Apple. Let's start looking at the debt of this company, which is the difference between the market cap and the enterprise value. As you can see, Apple has a market cap of $2.89 trillion. This means that if you bought every share on the market, at today's price, you would pay 2.89 trillion. Then the enterprise value is if you buy all the shares outstanding, plus paying for all the debt and then deducing the cash. So the difference between these two is essentially the debt. And as you can see, Apple has more cash than debt, which is a very positive aspect about this company. Now let's take a look at their dividend. They currently pay a very small dividend of 0.52% dividend yield. And I want to make sure that this dividend is safe. Because if a dividend is not safe, a company could cancel it and it could hurt the company. And the payout ratio is very small, 16%. And for a safe dividend, I usually look for less than 50%. So therefore, a very safe dividend. And my guess is that this dividend is not going to stop growing. If we take a look at the charts, their dividend has been growing over the past 10 years, but by a very small amount, and I think this is going to increase over time as they find less opportunities to invest in themselves. Now, to determine what price you should pay for Apple stock, I am going to use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions you put in about the future of the company on revenue growth, profit margin, free cash flow margin, P and price to free cash flow, the discount rate, and the change in shares outstanding. And I am going to do a 7-year analysis. I'm also going to do the assumptions as we go along. So let's start with revenue growth rate. As we can see, in analysts, this company is expected to grow between 0 and 8% over the next years, so an average of around 5%. And I'm gonna put on my low assumptions 4%, then on my middle 6%, and on my high assumptions I'm actually gonna put 8%, which some of you might think this is a lot, but I believe their subscription is gonna drive up a lot their revenue, which is basically their Apple TV, Apple Music, Apple Pay. I think this can drive up the revenue a lot. So this is why I'm going to put 8% for the next 7 years on my high assumptions. Moving on to profit margin and free cash flow margin, we are going to see that they are very consistent. As you can see right here on their financials, their profit margin over the past 10 years has been between 20 and 25%. But over the past 2 years, they have managed to increase it. And therefore, on my low assumptions, I'm going to go with 23%. Then on my middle assumptions, I'm going to go with 25%, which is what they are currently doing. And on my high assumptions, 27% in case they manage to increase them, which I definitely think is possible. And then if we take a look at their free cash flow margin, is very consistent also, but a bit higher. As you can see, between 21 and 28% over the past 10 years. So on my low assumptions, I'm gonna go with 24%, middle with 26%, and high assumptions 28%. I also want to say that I really like that their margins are very consistent because in my opinion, it makes it easier to value a company that has consistent margins. Then in terms of PE and price to free cash flow, their current PE is 31. However, remember that you should not compare the PE with the history of the company, but rather with the market average, which is around 15. Also, this PE and price to free cash flow are at the end of 7 years when you decide to sell the company. You should put a higher PE than the market average with a company that has growth potential and a great moat. And Apple has an amazing moat and still has some growth potential. And on my high assumptions, if they manage to grow 8%, I'm gonna put a 22 PE and a 22 price to free cash flow. On my middle assumptions, I'm gonna go with 20. And on my low assumptions, even though they are only going to grow at a 4% rate, Apple is still an amazing company, so I'm gonna go with 18. Then the discount rate is the return you want to get each year for the next 7 years on your investment. And because you can get around 8 or 9% investing in an ETF, if you take the risk of investing in an individual stock, you should put a higher rate of return. And also, as your assumptions get less probable, your rate of return should be higher. So I'm gonna go 10% on my low assumptions, 12 on the middle, and for my high assumptions, 14% desired annual return each year, which is a lot. Then, in terms of shares outstanding, we are going to see that Apple has been buying back consistently shares every year for the past 10 years. So we can also see that they have been buying around 3 to 6% of their shares every year. And you're gonna see how this price is gonna go up. And this means that a company, when they buy back shares, they can reward investors and their stock price can go up. So it's a way of rewarding investors who stock with the company. And I'm gonna put minus 3% on all assumptions. As you can see, according to my Excel spreadsheet, Apple stock is a bit overpriced right now, as according to my high assumptions, you should buy the stock between 160 based on profit margin and 173 based on free cash flow, middle around 140 and low around 120. I've been doing some research, and Warren Buffett, who as you all know owns a lot of Apple, buys Apple when it goes below 140. And honestly, in this case, I'm gonna agree with Warren Buffett, and I think Apple is a great buy below 140. I hope you enjoyed the analysis. Subscribe if you are new, and I'll see you on the next one. Thank you.